Welcome to the latest in conversation. My name is Pierre Braun, Senior Investment Analyst here at Pitcher Partners Investment Services. Joining me today is Adrian Chow, Portfolio Manager at Real Investment House. Adrian manages the High Income Fund, which is a multi-credit strategy which can invest in bonds. Adrian is coming here to give us some insights on the markets and how it navigated the current market conditions. First of all, it's obviously been a volatile year for the rates and debt markets. Could you give us some insights on how you manage risk in the portfolio?
For us, it comes to good product design and execution. It's really helped the fund deliver on its stated returns while minimizing volatility. So the Realm High Income Fund is an active multi-sector credit strategy which invests in corporate bonds and structured credit. There's also a strong focus on capacity constraints, which means the fund remains nimble and liquid at all times. The fund's active trading, contrarian positioning, and opportunistic approach means that the fund can tilt and rotate into dislocation, which we did quite successfully over the last 18 months. As an example, global markets sold off and dislocated quite significantly over the last 18 months, whereas Aussie dollar assets remained a laggard in terms of the sell-off. We were able to extract liquidity from Australian assets and reinvest into global credit markets. And over the last 18 months, we went through about 2 or 3 cycles where the global credit markets rallied back in and relative value normalized between global and domestic, and we were able to take profits on global and come back and sort of sit within the Aussie assets.
We saw weaker condition in offshore hybrid markets with the collapse of Credit Suisse. Have the condition now improved, and how have you managed your exposure to hybrid in the portfolio?
Yeah, I remember the March banking crisis period. There was significant volatility, significant dislocation, to the extent there was headlines or chatter about the requirement for a global hybrid asset class. Thankfully, the market has normalized significantly. Credit spreads have recovered around 70 to 75% from their pre-Credit Suisse levels. And there's been a good amount of new deal flow, and importantly, the demand has largely returned from the main buyer base. In terms of the Realm High Income Fund, it has a strategic allocation to Tier 1 bank capital of 15%. So during that March period when Credit Suisse collapsed, our exposure was around 13%. And we actively increased that to around 22% the weeks prior to the collapse of Credit Suisse. And that tactical overweight has done quite well for the fund's returns over the last 6 months. And as credit spreads and valuations have normalized to somewhat, we've taken profits and reduced that strategic overweight. It's currently around 18%. Interestingly, the domestic ASX listed Tier 1 market is currently under review by APRA. They are questioning the effectiveness of these ASX listed Tier 1 securities, given the fact that they're largely held by the retail investors. I think what that means is potentially you'll see a shrinking of the ASX listed Tier 1 market, and banks would potentially need to refinance these ASX listed Tier 1 securities at the over-the-counter market, which is generally higher yielding. So it will cost more for the banks, but positively it means the Realm High Income Fund will benefit given the universe of investable OTC securities should increase as a result.
Considering the lag effect of monetary policy on the economy, where do you stand on the risk spectrum now, and where do you see new opportunities?
The Realm High Income Fund must maintain a minimum credit rating of BBB flat, but it can tactically allocate up to 25% in sub-investment grade bonds. Current positioning is that the fund's credit rating is BBB flat, and the sub-investment grade exposure is around 22%. It's worth noting that the sub-investment grade exposure is largely made up of subordinated debt, such as bank Tier 1s and corporate hybrids, which are issued by strong investment grade credits, such as your major bank and the like. There's also a component of the sub-investment grade that's allocated to junior mezzanine tranches within structured credit, which provides very solid yields at lower volatility returns. We think the higher for longer interest rate environment or scenario would likely impact the smaller end of town a lot more than your high quality investment grade corporates. As such, our position reflects that we would rather invest in sub-debt of these investment grade corporates than actually have exposure to high yield loans or leverage loans. So at the moment, we continue to see opportunities in global Tier 1s. They've recovered quite a fair bit since the Credit Suisse collapse, but continue to trade cheap. We also see value in Aussie dollar corporate credits. They're currently trading not too far from COVID levels, so quite stressed levels, but the outlook is not as challenging for high quality Aussie corporate credits. Similarly, Aussie RMBS and ABS are trading at similar levels to where they were during COVID, which represents significant risk compensation and even at times overcompensation for the risk. So that's where we see value.
Companies must now service a higher cost of debt. What's your view on credit spreads, and have you been reducing your exposure to specific sectors?
Government bond rates plus the credit spread is currently trading at decade highs. So you're actually getting a lot of yield for the risk taken. And the benefit of having yield is that it provides buffer for the outlook. So we think the asset class is quite well positioned in terms of returns versus the risk outlook. In terms of positioning, we always ask the question about whether or not you're being compensated for the level of risk being taken. So with that, we went overweight into global Tier 1s when Credit Suisse collapsed in March, and we've been winding that back as valuations and credit spreads have performed and normalised. So the exposure to global Tier 1s currently is at 18%, reduced from 22%. And we've rotated that allocation into global Tier 2s as well as corporate hybrids, name-specific corporate hybrids such as Volkswagen, Centre Group, which continue to represent good return for risks taken. And as markets continue to normalise, as we expect, we'll continue to reduce that Tier 1 exposure back to 15% or lower and reinvest into Aussie corporate bonds and bank sub-debt.
You kept interest rate duration quite low in the funds. Could you describe your thinking behind it and the drivers behind it?
So we view the Realm High Income Fund as a credit product first and foremost. It does not take active calls on interest rate duration. Where it does utilise interest rate duration is to maximise portfolio Sharpe ratios or the risk-adjusted return. As adding interest rate duration can add significant volatility to your return series, we view the upper limit in terms of interest rate duration to be around 2 years. The current setting is half that at about 1 year, and that largely reflects the fact that there are sufficient credit opportunities in global markets currently.
Thank you for joining us today. Please remember to check the website and other videos on YouTube, LinkedIn, and please talk to us if you have any questions. Thank you.